Warren Buffett can rule out 90% of stocks under a minute. He's not looking at earnings growth or market share. He's scanning 5 specific lines on the balance sheet that reveal whether a business has a real competitive advantage. In this video, I'll share exactly what these 5 lines are, how to find them, and what they can tell you about whether or not a stock is worth your time. These 5 key balance sheet tests are the exact ones Buffett uses, taken directly from Mary Buffett's book, Warren Buffett and the Interpretation of Financial Statements. And stick around because I'm going to show you why Buffett loves one particular stock despite its razor-thin 2 to 3% profit margins that seem impossibly low by traditional investing standards. Hey, I'm Steve Reitmeister. I spent over a decade as editor-in-chief at Zacks.com, analyzing thousands of companies, and I'm currently a partner at WallStreetZen.com, where I can help simplify fundamental research for investors like you. And if you like this topic, please hit that like button down below. It tells me to make more videos like this in the future. Okay, before we dive into Buffett's specific tests, let's make it clear what a balance sheet actually is. That being a snapshot of everything a company owns and everything it owes at a specific point in time. It shows assets, cash, inventory, equipment, buildings. It shows liabilities, debts, and obligations, plus shareholders' equity, which is essentially what's left over for the owners. These two sides must always balance, hence the name balance sheet. If a company has $100 million in assets, the liabilities plus equity must also equal $100 million. Now, the goal of this video isn't to teach you all how to analyze every line item on a balance sheet. Instead, I'm going to show you the specific balance sheet metrics that Warren Buffett prioritizes above all else, okay? The ones that reveal whether a company has a true competitive advantage. Rule number 1, cash must exceed debt, meaning that a company must have more cash and cash equivalents than total debt. Buffett wants more cash sitting in the bank than the company owes to anyone. This tells you business actually generates cash or consumes it, right? Companies with durable competitive advantages typically generate enough cash so they don't need debt to operate. They're essentially self-funding machines. Now, think about a business like Coca-Cola or See's Candy, 2 of Buffett's favorite investments. They get paid immediately when they sell products, but they pay their suppliers 30, 60, 90 days later. They're essentially using other people's money to run their business. That's why they swim in a pool of cash. We'll also look at Costco throughout this video. I picked them because they're a textbook case of what Buffett looks for, and they're one of his personal holdings. And if you like what I'm saying about Costco, also share some similar picks with even better upside potential later on. Now let me show you Costco's balance sheet on WallStreetZen.com. When you look at Costco's balance sheet, you can see that its cash position significantly exceeds its debt. That's exactly what Buffett's looking for. The business generates so much cash from operations that it doesn't need to borrow. WallStreetZen tracks these kinds of liability metrics with our short-term liabilities and long-term liabilities checks in our due diligence section. This helps you quickly identify companies that are over-leveraged versus those with healthy balance sheets like Costco. Okay, rule number 2, debt to equity below 0.8. This means that the company's liabilities divided by shareholders' equity should be less than 0.8. This tells you how a company finances its growth. Buffett wants companies that can grow by reinvesting their own profits, not by borrowing money. Here's why this matters in real dollars. If Costco's debt-to-equity ratio were closer to 3, like Target, it would be paying roughly $500 million more per year just in interest payments. That's $500 million that can't be invested in new stores, better prices, or returned to shareholders. Over 10 years, that compounds into billions of dollars of lost value. Now, here's the trap. Some companies look over leveraged on paper, but when you dig deeper, the liabilities include things like deferred revenue or accounts payable. These aren't the same as owing money to a bank with interest. Costco is a perfect example. On paper, its debt-to-equity ratio is above Buffett's usual threshold, but when you break down the liabilities, a large portion is deferred membership revenue, which means that customers have already paid them. Plus, Costco manages accounts payable exceptionally well by turning inventory faster than it pays suppliers. Now, at WallStreetZen, we actually use an even stricter threshold of 0.4 for our healthy debt-to-equity check. Costco technically doesn't pass because of how those operating liabilities are classified, but stick around to the end of the video and I'll show you an even better way to quickly assess their financial strength of Costco and any other organization. Okay, rule number 3, consistent earnings growth. Earnings must show consistent growth over 7 to 10 years. That includes periods of recession. This is where Buffett separates pretenders from the true champions. A company can show rising earnings year after year and still fail this test if those earnings collapse during the tough times. Now, consistent earnings growth through downturns proves 3 things. The business is generally profitable, the model holds up under stress, and it has a real competitive advantage. Now, during the 2008 financial crisis, many companies that looked great on paper saw earnings collapse. Businesses with real economic moats kept generating profits, and Costco was one of them. You can see that Costco's earnings continued growing through both the 2008 crisis and the 2020 pandemic. While many traditional retailers were laying off workers and closing stores during COVID, Costco was hiring and opening new locations. That's a durable competitive advantage being stress tested in real time. This is exactly what long-term earnings growth checks are designed to catch, not one-year spikes, but consistency across business cycles. If you want more deep dives like this one, please click that subscribe and notification bell below. It's the best way to get access to the multiple videos I release each week showing how professionals analyze stocks. Now, the next rule is where many investors have kind of an aha moment. And that's rule number 4, high return on equity, which we also symbolize as ROE. This means the return on equity must be consistently above 15%, ideally 20% or higher. Buffett calls this the management report card because it shows how efficiently a company turns shareholder capital into profit. An ROE of 20% means that every dollar of equity, the company produces 20 cents of annual profit. Here's the key insight most investors miss. Imagine two companies, one growing earnings at 20% a year and another growing at 10%. Most people would choose the one that was growing faster. But if the faster growth has an ROE of only 8% and the slower growth company has an ROE of 30%, the slower growing company may actually be the better investment. That's because the first company is growing by constantly raising capital and diluting shareholders. The second is compounding wealth with the capital it already has on hand. Costco is a great real-world example. Despite operating on razor-thin 2 to 3% profit margins, it consistently generates ROE in the 25 to 30% range. That's because of rapid inventory turnover, upfront customer payments, and delayed supplier payment. This isn't a fluke. It's sustained capital efficiency, the hallmark of a great business. Now, WallStreetZen flags this with a high return on equity check designed to surface companies that consistently generate strong returns. Now on to rule number 5. No preferred stock. The company should have 0 preferred stock on the balance sheet. That's because preferred stock is kind of a hybrid form of debt, and companies usually issue it when they're under financial stress. For non-financial companies, it's almost always a serious red flag. Now, companies with durable competitive advantages don't need preferred stock. They generate enough cash to fund themselves and can raise regular debt at attractive rates as needed. Costco has never needed preferred stock, a sign it has never faced financial stress severe enough to require this emergency form of capital. When you see preferred stock on a balance sheet, it often signals past trouble. The absence of it, combined with the first 4 rules, signals strength. So those are the 5 Buffett balance sheet tests. And if you are probably thinking, that's nice, but kind of a hassle tracking that information down stock by stock, well, that's what we do at WallStreetZen.com. We've taken these classic value investing principles and built them into a quantitative system that does the hard work for you. Call it the Zen ratings. When you look at the Zen ratings for Costco's, you'll notice it's currently a C or hold rating. That may seem to contradict everything we just covered, but stick with me for a second. Financially, Costco scores extremely well in our quant model. The reason it's not rated higher right now comes down to valuation. The business quality is excellent, but the stock price reflects much of that strength already, and thus the upside potential for shares is muted, leading to the C rating. The Zen ratings analyzes 115 factors across financials, valuation, growth, momentum, and analyst sentiment. Only the top 5% of stocks earn our coveted A rating. And going back to 2003, it has pointed out stocks that have averaged a 32.5% annual return, nearly triple the S&P 500. Costco is a wonderfully run business. It's just not a screaming buy at today's price. Warren Buffett spent 80 years figuring out what separates great businesses from mediocre ones. These 5 balance sheet tests quickly distill that wisdom. Costco's balance sheet reveals what the income statement hides: massive cash generation, strong capital efficiency, and returns on equity above 25% despite those low margins. Costco doesn't need high margins because its membership model and negative working capital structure generate enormous cash flow. That's why Buffett owns it. Right now, it's a hold according to our Zen ratings, not because the business is weak, but because valuation matters. Smart investors identify great businesses first, then wait patiently to buy it at the right price. As Buffett says, it's better to buy a wonderful company at a fair price then a fair company at a wonderful price. However, if you want to explore other stocks while you wait for Costco to come down in price, you can check out stocks that are in the same industry that are currently higher rated. For instance, Costco is part of the top rated discount store industry. It just so happens there are other stocks right now on the list that have higher ratings in our Zen rating system. Please remember that the Zen ratings are updated daily, so you can keep checking back to see what's rated well so you can buy at the best possible time. Just use the link in the description below. And if you want to keep learning about value investing principles like this, don't miss my video on exactly how to know if a stock is overvalued and time to sell before it implodes.